Jake Carter had finally reached a major milestone. After years of hard work, careful saving, and smart financial decisions, Jake had accumulated $250,000. For many people, that amount of money would feel life-changing, but Jake knew something important. Saving money is only the first step. The real challenge begins when you decide what to do with it. One decision could turn $250,000 into millions. Another could leave huge opportunities on the table. So Jake asked himself a simple question. If you had $250,000 today, where would you invest it? Would you choose monthly income? Would you focus on maximum growth? Or would you diversify your money across the world? Most investors never seriously compare these options. They simply follow trends. They buy what everyone else buys. But Jake wanted real answers. He wanted numbers. He wanted proof. So he decided to run an experiment. Same investor, same starting amount, same timeline. 3 completely different strategies. And the results were shocking. The first strategy promised a growing stream of income. Money arriving month after month without selling investments. The second strategy focused on aggressive growth. The goal wasn't income. The goal was creating the biggest portfolio possible. The third strategy looked beyond America. Instead of betting on one country, Jake wanted exposure to businesses all around the world. 3 paths, 3 possibilities, 3 very different futures. But only one question mattered. Which strategy could create the most wealth over time? To find the answer, Jake opened his laptop, pulled up the numbers, and began his journey. What he discovered completely changed the way he viewed investing forever. Jake Carter decided to start with the first strategy, income investing, because let's be honest, most people dream about one thing: making money without working for it. Imagine waking up in the morning and seeing money deposited into your account, not from your job, not from a side business, but from investments you already own. That idea fascinated Jake, so he started researching dividend-paying companies. These weren't flashy startups. They weren't risky speculative businesses. They were established giants, companies that had survived recessions, market crashes, inflation, and decades of economic uncertainty. Businesses like Coca-Cola, Pepsi, Johnson & Johnson, and many others. These companies generate billions of dollars every year. Instead of keeping all the profits, they share part of that money with shareholders. That's called a dividend. The more shares you own, the more income you receive. Jake loved the concept, but he wanted bigger numbers. So instead of investing only $100,000 like most examples online, Jake imagined investing $250,000. Immediately, the projections became far more exciting. In the first year alone, his portfolio could generate thousands of dollars in passive income. Money arriving whether he was working or not, whether he was sleeping or traveling. The income would continue flowing, month after month, year after year. But then Jake discovered something even more powerful: dividend growth. You see, many great companies don't just pay dividends. They increase them again and again, year after year. A company might pay $1 today, then $1.10 next year, then $1.20, then $1.30. The payments slowly grow larger over time. And that's where the magic begins. Because Jake wasn't spending those dividends, he was reinvesting them. Every payment bought additional shares. Those new shares generated additional dividends, which bought even more shares. And the cycle continued. The portfolio wasn't just paying Jake, it was helping itself grow. As years passed, the numbers became larger, the income became stronger, the account balance continued rising. For the first time, Jake realized something important. Passive income isn't created overnight. It's built one dividend at a time, one reinvestment at a time, 1 year at a time. And if he stayed patient long enough, his portfolio could eventually pay him more money in a year than many people earn from a full-time job. But despite how impressive the income looked, Jake still had one question: could another strategy create even more wealth? To find out, he turned his attention to the second path, the growth strategy. And what he discovered next completely changed the game. After exploring the income strategy, Jake Carter turned his attention to the second path, growth investing. This strategy wasn't designed to pay him today. It was designed to make him wealthy tomorrow. The difference was huge. Instead of focusing on dividend income, Jake focused on companies growing faster than almost everything else in the market. Technology leaders, artificial intelligence innovators, cloud computing giants, companies shaping the future. Jake imagined investing the same $250,000, but this time, every dollar would be working toward one goal: maximum growth. At first, the strategy seemed boring. The portfolio wasn't sending large dividend payments. There were no exciting monthly cash deposits, no passive income notifications, just numbers moving on a screen. But Jake understood something most investors miss. The biggest fortunes are often built quietly. 1 year passed. The portfolio grew. Then another year. The growth continued. As the companies expanded, their stock prices climbed higher. The gains became larger. And then something incredible happened. Compounding started accelerating. The first few years felt slow, but later years became powerful. The portfolio wasn't growing by thousands anymore. It was growing by tens of thousands, then hundreds of thousands. Jake watched the numbers carefully, and he realized something shocking. The later years were doing more work than the earlier years combined. That's the true power of compounding. Most people quit before they reach that stage. They get impatient. They want results immediately. Jake stayed focused. Market crashes came. Bad news appeared. Experts predicted disaster. Social media panicked. But Jake kept investing, because he knew short-term fear often creates long-term opportunity. Years passed. The portfolio kept climbing. For the first time, Jake saw projections showing millions of dollars. Not because he was trading, not because he was taking huge risks, but because he owned great companies and gave them time to grow. The numbers became almost unbelievable. A portfolio that started at $250,000 now had the potential to become several million dollars over the coming decades. Far larger than the income strategy, far larger than Jake originally expected. But there was still a problem. Every dollar was concentrated mostly inside the United States. What if another part of the world performed better? What if global opportunities emerged? What if America wasn't always the strongest market? Jake needed one final answer, one final strategy, and that led him toward the third path: international investing, a strategy most investors completely ignore, but one that might be more important than Jake realized. Jake Carter had now explored two powerful strategies. One focused on income, the other focused on growth. But a question still bothered him. What if the next great opportunity didn't come from America? What if another country became the world's fastest growing economy? What if the future looked different from the past? That's when Jake discovered international investing. Most investors spend their entire lives buying only American companies. Apple, Microsoft, Amazon, Google, amazing businesses. But the world is much bigger than the United States. There are thousands of successful companies across Europe, Japan, Australia, Canada, and many other countries. Companies making billions of dollars every year. Companies most American investors never own. Jake decided to investigate. He opened a world map and started looking beyond US borders. Suddenly, new opportunities appeared everywhere. Luxury brands in Europe, technology companies in Asia, industrial giants in Germany, global banks, pharmaceutical leaders, manufacturing powerhouses. The world was full of businesses generating enormous profits, and many of them were trading at lower valuations than similar American companies. That caught Jake's attention, because lower prices can sometimes mean better long-term returns. Of course, international investing wasn't perfect. Different countries have different risks, different currencies, different governments, different economic conditions. Sometimes international markets outperform America, sometimes they don't. But Jake wasn't trying to predict the future. He was trying to prepare for it, and diversification helped him do exactly that. Instead of betting everything on one country, he could own a piece of the entire developed world. Now his money wasn't dependent on a single economy, a single president, a single market, or a single currency. The portfolio became stronger, more balanced, more resilient. Jake realized something important. Diversification doesn't always make you richer, but it can make your journey smoother. And smoother journeys help investors stay invested. The biggest investing mistakes usually happen during fear. When markets crash, when headlines become negative, when emotions take over. Diversification helps reduce those emotional decisions. That's why Jake added international investments to his strategy. not because they would always win, but because they would help protect him when other parts of the portfolio struggled. Now Jake had three powerful tools: income, growth, and diversification. But one huge question remained: what would happen if he combined all three together? The answer surprised even him, because the final portfolio was stronger than any single strategy alone. Jake Carter had now explored all three strategies: income, growth, and international diversification. Each one had strengths, each one had weaknesses. But Jake wasn't interested in finding the perfect investment. He was interested in building the strongest portfolio possible. So instead of choosing only one path, he decided to combine them. One portfolio, three powerful engines. The income strategy would provide cash flow. The growth strategy would drive long-term wealth, and international investments would add diversification. For the first time, Jake felt like he had a complete system, not a prediction, not a gamble, a system. He imagined investing his entire $250,000 across all three strategies. Immediately, the portfolio looked different. It wasn't as aggressive as the growth portfolio. It wasn't as focused on income as the dividend portfolio. But it offered something incredibly valuable: balance. And balance creates staying power. As the years passed, the portfolio continued growing, not because one investment carried everything, but because multiple investments worked together. When technology stocks surged, the growth section pushed the portfolio higher. When markets became volatile, the dividend section provided stability. When America struggled, international holdings helped offset some of the weakness. Jake finally understood something that many successful investors learn late in life. Winning isn't about finding the single best investment. It's about building a portfolio you can hold for decades. Because the biggest enemy of wealth isn't market volatility, it's quitting too early. And diversified portfolios help investors stay invested. Year after year, Jake watched the account grow. The numbers became larger, the confidence became stronger, and eventually the portfolio crossed $1 million, then $2 million, then $3 million. At that point, Jake realized something incredible. Financial freedom wasn't a dream anymore. It was becoming reality. The portfolio was generating income, the portfolio was growing, and the portfolio was protected against many of the risks that destroy investors. The journey hadn't been easy. There were crashes, corrections, scary headlines, economic uncertainty, but Jake stayed committed because he trusted the process, and the process rewarded him. Now there was only one final question left. What if someone doesn't have $250,000 today? What if they're starting from zero? Can an ordinary person still build wealth? The answer might surprise you, and it's the most important lesson Jake learned during his entire investing journey. Jake Carter sat quietly and looked back at everything he had learned: income investing, growth investing, international diversification. Each strategy had taught him something valuable, but the biggest lesson wasn't about ETFs. It wasn't about stock market returns. And it wasn't about finding the perfect investment. The biggest lesson was much simpler: start. Because most people spend years searching for the perfect strategy, the perfect stock, the perfect time to invest, the perfect market condition. And while they're searching, time keeps moving. Jake realized that even the best investment strategy in the world is useless if you never begin. That's why wealth isn't created by knowledge alone. It's created by action. Small actions repeated consistently over long periods of time. The first investment may seem insignificant. The first $100 may feel too small. The first $1,000 may not seem life-changing. But every large portfolio starts exactly the same way, with a first step, a first contribution, a first decision. As Jake reviewed the numbers one final time, he noticed something interesting. The investors who became wealthy weren't necessarily the smartest. They weren't always lucky, and they didn't always have the highest incomes. What separated them from everyone else was consistency. They kept investing when markets went up, when markets went down, when the news was positive, and when the news was terrifying. They stayed focused because they understood something most people never learn. Time is the most powerful asset an investor will ever own. Not money, not stocks, not ETFs. Time. The longer your money stays invested, the harder it works, and the less you need to rely on luck. Jake smiled, because he finally understood the secret. There was no secret, just patience, discipline, and consistency. The same principles that have built wealth for generations. So whether you're starting with $100, $1,000, or $100,000, the journey begins exactly the same way, with a decision to start today, a decision to stay consistent, and a decision to let time work in your favor, because years from now, the future version of yourself will either thank you for starting or wish you had. The choice is yours, and the best time to begin is now.